Welcome back to Data and Context. I'm Allie Barefoot with Cotality. This episode is a part of a mini-series where we break down Cotality's monthly home price index report. The U.S. housing market is currently in a holding pattern. Mortgage rate volatility has cooled seasonal momentum, yet sellers are refusing to drop their prices. So instead of seeing a national trend, we're seeing a dramatic split in opportunity. Inventory-starved markets are seeing prices rise, while undervalued tech giants are quietly priming for a major rebound. So to break down this data, we're going to be talking with Dr. Selma Hepp, Cotality's chief economist, to see what Cotality's May home price index report is really telling us. Let's put the data into context. Welcome back to Data and Context, Selma.
Thanks, Allie. Thanks for having me back.
Of course, we're talking about Cotality's May home price index report. So we'll go on ahead and start by setting the scene and looking at the big picture. The national number indicates a slowdown, with year over year price appreciation rising just moderately to 0.4%. And you've described this housing market as being in a holding pattern, per se. What exactly is keeping us stuck right now? What exactly is that holding pattern?
Yeah, that's a great question. I think what's keeping the market stuck right now is a combination of few things. It's a combination of strained affordability, rate uncertainty. We've seen rates jump back up, and consumers who are really, unsure of what's going on. They're unsure of rate environment. They're unsure of inflation, and they are now still waiting. Really the national number that you mentioned says it all. So annual home price appreciation was just 0.4% in March year over year. So that in essence is telling us that, prices are essentially flat. I mean, they're rising, but barely. And then the other thing that really says it a lot is the consumer confidence data. Latest consumer confidence data show why buyers remain hesitant in many ways. Nearly half of them expect mortgage rates or interest rates in general to move higher over the next year. Even 2/3 of them said they're already cutting back on or delaying big purchases. So when you bring that back into the housing, the result is a market that's in limbo. Buyers are still interested, but many are waiting for the better financing option. And then on the seller side, they're sort of in a holding pattern as well. They have equity in their homes, and in many cases, they don't need to leave. Don't need to move. There's another point that's maybe less appreciated. It's that the stickiness of the housing market at the moment is not more. It's not anymore just about the supply shortage story. It's that growing number of markets are seeing activity that's being determined by price realism. And what I mean by that is that homes that come to the market that are right price, they are moving, they are being sold, while overpriced listings just end up sitting still on the market. So that means that market is not frozen everywhere. It is really selectively moving where price discovery is finally happening.
Right. So it seems like neither side is really willing to move that needle to open up what we kind of need right now in the US housing market. And let's stick with the seller side here for a minute, because if sellers aren't budging, then we're seeing a stark divide across the map entirely. So the pandemic era darlings of the South and the Mountain West, we've seen a notable cooling because home prices simply outpace local paychecks in those areas. But the Cotality May home price index report reveals that some of these regions are already bouncing back. Can you take us through those numbers a little bit about where the areas are actually starting to see some movement?
Yeah, absolutely. So, the areas where we're seeing the sharpest cooling happened, those are the markets that prices went up too high compared to the local incomes during the pandemic. And now we're seeing sort of splitting between into two paths of those markets. For example, in Austin, that's a good example. Prices have reset. They're still about 15% below their mid 2020 peak, but since the start of this year, they have actually been on the rise and have risen significantly. They're up about 2.5% since the start of the year. Oakland, for example, that's one of the slowest market that was appreciating during the pandemic, also showed a similar pattern coming into this year, with prices almost up 2% year to date. Even, a third one, for example, Boise, Idaho, that was, the total what did you call it? Darling, the pandemic era darling. That market, has surged significantly early in the pandemic and has been through several corrections since. But now that market has seen boost this year as well. So, this is all telling us that, formerly overheated market are starting to find a floor, even after this meaningful correction. We also have, for example, Florida. That's, we talked a lot about Florida over the last few years with its own correction story, but it's a little bit different. The state itself is down about 2.4% year over year, which does make it one of the weakest performing states nationally. And it also reflects the fact that inventory has expanded faster, for example, than some other areas. And also affordability was hit harder because home prices appreciated so much. But even in Florida, many markets are rebounding too now again. So the important takeaway is the correction is no longer broad or uniform. It depends on the market. 1/3 of the top 100 markets are still posting year-over-year declines, but that list is not meaningfully expanding. So it's in essence suggesting that this adjustment phase is maturing. And the other thing is sort of to the way to think about it is some markets that look weakest on a year-over-year basis may now actually be offering clearer sign of normalization because they're the ones where pricing has reset enough to bring buyers back.
Right. So once again, it's just not that national trend, but really just closing your eyes, putting your finger on a map, and that area is going to tell you a drastically different story from
Yeah.
perhaps close your eyes and pick another area
Yeah.
on the map. And I noticed that we continuously monitor this in our month-to-month home price index report. But there was something that stuck out to me about May's report, and that was an eye-opening takeaway from the West region, talking about like kind of the West Coast, those tech hubs like Seattle, San Jose. And you mentioned that, the year over year, they might look a little bit different, but on paper, they look like they're struggling year over year, where those numbers are still in the negative. But you're also signaling that these markets are actually a massive opportunity right now. So what are the underlying fundamentals really telling us that just because those numbers look like in the red, they may not necessarily be struggling?
Yeah, exactly. This is a clear example where year-over-year numbers can be very misleading. Seattle and San Jose, as you mentioned, they're still soft on papers because you were comparing it to some higher levels of last year. But I think what's more important at the moment is to look at the story about valuation and momentum. So, for example, after they've seen some correction since 2022, only a small number of markets are now considered undervalued relative to their historical fundamentals. And San Jose, for example, one of them. And we are already seeing that buyers are noticing that, and coming back into the market. And so San Francisco, for example, saw home prices up 5% just in the first 3 months of this year. And this type of quarterly increase in home prices is only speaking to the demand that's returning faster than these annual numbers are suggesting. What's important about these markets and why they're on the up again is that they benefit from very high income and also deep job concentration, which now favors AI. There's been we talk a lot about this on every webinar, every story that you see about investment in AI and job creation of AI type jobs. Those markets also have a long-term supply constraints. And so, taken together, it means that affordability has improved a little bit, but it has bring demand back because of these other dynamics happening in the market. And then again, another way to look at it is some of the best opportunities today are not necessarily in the hottest affordable markets, but are in these
Right.
expensive markets that have corrected. In other words, weakness in this coastal tech hub may be less of a sign of structural decline and more a sign of repricing that was needed in order to bring back recovery.
Right, right. It really highlights a growing divide of who can kind of participate in today's housing market and where they can participate. And as you noted in this report, we're seeing a real split in opportunity. Like we said, there's not really a national trend that we can follow, but in terms of that split opportunity, is there a winner or a loser in this type of opportunity, or is it more so just where you end up and what your area kind of looks like? Who's winning or losing per se in this environment, if there is one?
Well, I would definitely say that there are households there benefiting from have greater opportunity. And the households that are winning in these environments are the ones that have more flexibility. They have substantial equity from the home they were already in, they have higher incomes, or they have enough cash to reduce the dependence on, volatility in mortgage rates. And so we are even seeing, talking about consumer confidence earlier, we're seeing stronger confidence among these higher income households hold up better, while lower income households are feeling the greatest pressure now from the inflation and just rising everyday costs. And so that divide matters in housing because affordability is no longer just about whether somebody can buy, it's whether they can absorb that monthly payment, and so these buyers with equity from previous home or significant savings that allows them to compete and negotiate and take advantage of the markets that are correcting. Um, on the flip side, unfortunately, there are households that are losing ground in this environment, and those are first-time home buyers, and there are moderate-income families that remain very highly payment sensitive. In markets where national prices are up, even as little as 0.4%, you know, increase in mortgage rate makes entry into home ownership really hard to get, not easier. So this is why it is such a split opportunity. Markets, the markets are still functioning, but they're functioning better for households that already own assets.
Right. And looking forward, Cotality's forecasting data points toward a broader market rebound by March of 2027. Between now and then, what is kind of the ultimate wild card that buyers and sellers need to watch out for? Of course, there's always several when you look a year ahead into the future, but something that might be on your mind right now as we look month to month.
Yeah, there's really a lot of wild cards are out there at the moment, and they actually in many ways will determine how wide or broad market rebound we in fact see, which a lot of folks are now wondering, the rise in mortgage rates has been a detriment to the spring home buying market, and we have not seen a rebound as much as we anticipated, and that's going to play out in future home prices as well. So naturally, one wild card we gravitate towards is still mortgage rates, but the fact that we're contending with these inflationary pressures, that everything is more expensive, that we are not sure exactly how consumers are going to respond to that in terms of wanting, being willing, able to buy these bigger items. The other thing is, what does it mean for inventory? Maybe some people are going to feel more stuck or remain in their home because of the uncertainties around them and these wild cards. And then the last thing is on new construction. We can have new construction activity being impacted by these higher rates too. So, there's a lot of wild cards to work with. one thing we do know, if we do see even a modest decline in mortgage rates, there does remain a lot of pent-up demand that's really ready to come back into the market. And, with inventory still being so tight in many regions, that could quickly translate into faster home price gains and more home sales. We don't know, but if mortgage rates do remain elevated or even as volatile as they've been, their market could stay sluggish for longer than we expected. So the way I think about the next phase of the housing market, it's maybe less driven by dramatic drop in rates and more by life events and gradual affordability repair through wage growth, combination of wage growth and slower rate of home price appreciation. We're already seeing the evidence that those sellers that have been locked in, that lock-in effect is slowly weakening, with more sellers now willing to list despite giving up low mortgage rates that they had. So for the buyers and sellers, the key thing to watch is not just rates and if rates fall sharply, but whether enough households decide they can no longer wait. They retire, they move, they get a new job. These are three things that still continue to determine the housing market, and that may be what ultimately gets the market moving again.
Absolutely. Almost like it's not a national trend. We're looking at different regions. We also have to look at different households. Everybody kind of has a different story here in this housing market. And while May 2027 is a long way away, thankfully, Cotality does have a monthly home price index report where we get to dive deeper, just like this, into what that data is actually telling us. So thank you so much, Selma, for breaking down what May has really shown us here in the last couple of months. And I'm very excited to talk with you next month to see what that data is showing us as well.
I am anxiously looking forward to it as well.
Thank you again to Dr. Selma Hepp for joining us on Data and Context, and thank you for listening. If you haven't already, subscribe to Cotality's YouTube channel, and if you want to find out more information, as always, head over to cotality.com.